Okay, are you there?
Yes, miss.
Okay. So go back to the issue of current liabilities or the short term here debt if they are refinanced. So how should we deal with them? Should we? So the main question here was to tell if this short term debt to be, of course, refinanced should be kept as part of the short term liabilities or should be, of course, reclassified as long term liabilities. Okay. Um, so we'll see here the answer regarding that exercise here. So we said that if we will be refinancing the short-term debt here with long-term liabilities, then of course there is no need to keep them as short-term debt. Or also if you have, of course, this unconditional right to defer the settlement for more than 12 months, starting, of course, from the reporting date here, we have to report them as long-term liabilities. So should be excluded from the current liability section. So let's take this example. The CFO for Young Corporation here is discussing with the company chief executive officer issues related to the company's short-term obligations. Presently, both the current ratio and the asset test ratio for the company are quite low, and the chief executive officer is wondering if any of the short-term obligations could be reclassified as long-term. The financial reporting date is December 31. Two short-term obligations were discussed and the following action was taken by the CFO. Okay, so it said that you should say how this transaction should be reported at December 31 and Young's, of course, statement of financial position. The first issue is related to obligation A. Okay, so it was here 50,000 short-term obligation that is due on March 1st, 2019. And now it said that the CFO here discussed with its lender whether the payment could be extended to March 1st, 2021, provided Young agrees to provide additional collateral. An agreement is reached on February 1st, 2019 to change the loan terms to extend the obligation maturity to March 1st, 2021. The financial statements are authorized for issuance on April 1st, 2019. So please, this actually, this timeline, it's really important to be able to tell if this $50,000 should be still reported as short-term obligation because it is due actually on March 1st. That's the initial situation, or should be reclassified as long-term liability, given, of course, this discussion to extend it, of course, the deadline here or the maturity date to March 1st, 2021. And of course, here the agreement that was reached on February 1st. So here we have what? December 31, we have that liability, that initially, of course, short-term liability of $50,000. On February 1st, 2019 here, the agreement regarding the refinance, of course, is completed and already achieved. Of course, liability that is initially due for payment was on March 1st, 2019. And of course, as we said, the financial statement are authorized for issuance on April 1st, 2019. So according to you, this short-term obligation A should be considered as long-term or short-term obligation. What do you think?
Before the refinance or after?
We are in December 31. Be careful. So we are in December 31, 2018. At this level, we started, of course, the discussion, but we didn't reach yet the refinance here agreement. Okay. The refinance agreement was reached, completed on February 1st, but liability, of course, due for payment was for March. That's, of course, initially. And we have the information that also the financial statement are authorized for issuance, so will be issued on April 1st. So, of course, here, 2 months after the agreement was made, okay? So of course here it should be reported still as current liability. علاش؟ على خاطر we should not consider actually the date of authorization for of course for issuance for the financial statement. So احنا قلنا the criteria here to disclassify, let's say, from the current liability is that we talk about reporting date. Okay, the reporting date is still the December 31, 2018. So here the refinance agreement was made after this reporting date. Okay, so here it should be kept as short-term liabilities. It should be considered to be as a current liability. It is due on March 2019. Why? Because December 31, we don't have here the any agreement made, of course, at the reporting date. So it should be considered as current liability. Okay. Even though we have this issuance, of course, authorization on April 1st, so 2 months after the, but we close. So you know that we have actually two important dates, and we have a time lapse between the two important dates, the reporting date and the date of issuance of financial statements. Okay, so the reporting dates, of course, that's in general. For most companies, it will be December 31. That's the date when we close our books, okay? And then, of course, we may take some months, of course, to prepare financial statements and issue them, okay? So if we issue the financial statement on April 1st, 2019, doesn't mean that we already covered January, February, March. No, it was, of course, issued on April 1st, but it will cover the period from January 1st, 2018 until December 31, 2018, okay? So that's why, of course, we consider only the reporting date, which is December 31, okay? So for obligation A, we are not allowed to reclassify it as long-term liability. It should be considered and kept within the current liability section, okay? So let's see for obligation B here. Young also has another short-term obligation, 120,000, due on February 15. In its discussion with the lender agrees to extend the maturity date to February 1st, 2020. The agreement is signed on December 2018. The financial statement authorized for issuance on March 31. Okay, so here the situation is really clearly different. Okay, you got a discussion with the lender and you get this, you reach the agreement regarding the refinance. So you have this unconditional, let's say, right to defer the settlement for at least 12 months after the reporting date, which is really met with this agreement on December 18. Okay, so of course this liability of 120 it will be allowed to be reclassified as a long-term liability. So it should be reported as the current liability. Okay, so it should be taken off from the current liability section and included in the non-current liability section. Okay, so that's really important. The agreement should be reached or will be in place as of the reporting date. So after the reporting date, it won't be considered in this, of course, classification into long-term liabilities. Okay, is that clear, please?
Yes, it's clear.
Okay, good. Now when you see, of course, dividends payable, you know, they are amount owed by a corporation to its stockholders, so shareholders, etc., as of course a result of board of directors authorization. So here, remember, when we declare payment of dividend, this amount, we have what? We have a liability as a business. So we should, of course, debit dividends, and we credit dividends payable, okay? And of course, after the date of declaration here, this, of course, dividends will be paid in general within 3 months. That's why, of course, that's explained the fact that they are considered to be current liabilities, okay? When you have this undeclared dividends on cumulative preference shares are not recognized as a liability. So please, the keyword here regarding the dividends to be considered actually as current liability is that only when they are declared. Only when they are declared by the board of directors, okay? So if we have any undeclared dividends, even though, of course, for this undeclared dividends, and you will see it in chapter 15, inshallah, in the next semester, when you have, of course, these preference shares, and they have actually this right to keep receiving these dividends when the firm decide actually to to distribute dividend, etc. So the criteria to consider any liability regarding these dividends is only when they are declared. So when we declare, then of course immediately as a business I should report it as a liability. So if there is no declaration of dividends, there is no liability. Okay. Again, here when we talk about dividends that they are payable in the form of additional shares, they are not of course a liability. Here when we pay pay off dividends, but in the form of distribution of free shares, here they are not to be considered as a liability. Okay, so it will be an additional, of course, as an increase in capital. Okay, so this is what I'm saying here. It should be reported in the equity section. Okay. Other types of current liabilities when you have these customer advances and deposit. Okay. So when you have any returnable cash deposit that you receive from customers and employees, and they are just, for example, receive it as, I don't know, collateral or any guarantee, for example, for any transaction with the customers and employees. So they are actually refundable or returnable cashes, and that's why, of course, should be recorded as a liability. Can be, of course, current or non-current, depending, of course, on the agreements. Okay. Here, when we talk about unearned revenues, you know, the unearned revenues when you collect money from customers, of course, and this money is collected before you perform a service, before you sell goods or whatever. Okay, that's what we qualify as unearned revenues. Okay, so when you collect, for example, money, you are, I don't know, an airline, airline, for example, company that is and you will be, for example, booking a place on that air flight, etc. You will, for example, take the plane the next month, so you will purchase a ticket now. Okay, so purchasing that ticket, it's kind of an earned revenue for this airline company. Why? Because they are collecting money before performing a service. Okay, so they are not, of course, allowed to report it as revenues. They should report it as an earned revenue. So here we have other examples like an earned subscription revenues, like an earned rental revenue, like an earned warranty revenue, etc. Okay, so all of these, they are kind of current liabilities. Okay, of course, once we have, with the passage of time, or when this unearned actual revenue, it will be converted into revenues when the firm, of course, will be performing. It will perform, it will provide the service, it will sell goods, or, for example, deliver merchandise, etc. Okay. Okay, so let's see this example regarding this unearned revenues. Okay, so we have here Sport Pro magazine. That sold 12,000 annual subscriptions on August 1st for 18 each. Prepare Sports Pro August 1st, 2019 journal entry and the December 31, 2019 annual adjusting entries. Okay, sorry, just. Mahati. Okay. Mahati. Listen, Mama, listen. Mama, Mahati. Okay, okay. Mama, Mahati. Aku Mahati. Mahati. Sorry for the interruption. You have a new guest. This is my daughter. She wants to join our session, so I'm sorry again.
It's okay, Miss.